The bond market flashing a major recession warning with the 210 spread the most inverted in over 4 decades. But then there are jobless claims which are still near all-time lows. So as an investor, which data points matter more? Let's ask Keith Fitz-Gerald. He's the principal of Keith Fitz-Gerald Group. Did I have that right? I think Fitz-Gerald Group principal. Keith, I'm so sorry. Welcome. It's good to see you again.
No worries. I also go by hey you or oh no, it's him again. So that was close enough.
Well, we're thrilled you're here to weigh in on this big debate everyone's having over the data. And listen, from my point of view, it seems like the bond market's always leading, the job market's always lagging, and that's a worrisome sign. But you've had much more experience. What do you think is going on here?
Well, I tell you, I would increasingly go with the jobs markets, and here's why. Bonds are a hypothetical construct based on fear of interest rates or changes. Jobs are very real. What that tells you when you get to the real part is that companies still need more workers to keep up with demand. Now, granted, the composition is that is shifting from tech to hospitality, but it's a real number nonetheless. So I'm going to go with jobs every single day of the week. I don't care about the academic argument, recession or not. I think the Fed's got it wrong. Those models are busted. CEOs, on the other hand, particularly like Pepsi, they're getting it right.
So we'll get into definitely some of the stocks that you like here, because actually Tesla is one of them, which a lot of people will find interesting. But one more question about the labor market. I also, in a way, wonder how much better can it get from here, right? Are we just going to stay at these historic levels of jobless claims? Are we going to stay at record low unemployment? It seems like the only way to go from here is worse. And then wouldn't you want to be fading that, you know, from the market's point of view? Inevitably, I don't think it can get any better.
Well, instinctively, of course, you're going to want to fade it because that's what your guts are telling you. But what we also know from research and a huge body of history is that the markets have an upside bias. You find treasure at the bottom of the ocean, and typically that's what happens when the markets drop. So if you're sticking with the right companies, the brand names, the CEOs who are moving forward, I would submit over time that's the better and arguably the more profitable play.
Well, as we often know, you can kind of get the macro right or wrong, but still make plenty of money if you're in the right trades. For instance, Tesla, you know, you stuck your neck out on this just at the right time. You still a fan of the stock?
Oh, absolutely. I think this thing is just getting started. Anybody betting against Elon Musk, whether they like him or not, that's moot. But anybody betting against Elon Musk today might as well have been betting against Steve Jobs back in the day. We know how this is going to play out. He unleashes just incredible transformation in every industry he touches. He's not getting stopped anytime soon. He's got enough money to do what he wants. He's got a clear vision. I'm very excited. I think it goes back to 300 a lot quicker than people think.
Let's talk about that for a moment, because a lot of investors the last couple of years have learned that it doesn't just matter if you like or don't like a stock. It matters where you enter and where you exit. Why not take the profits now? Why say I'm staying in this till 300? And would you really not get out at 250 or 270 or 280 if we get up there?
Well, every investor is different, of course, and that depends on what your unique risk tolerances are, your profit objectives, et cetera. I'm a big fan of when you have a double, you take half off and you let the remaining shares run for free, because now you've paid for your initial investment, you're still in the game, and you can continue to add more later if you want. So it's not a question of all or nothing, Kelly. You know, take some money off the table if that makes you feel good, lets you sleep better at night. Nothing wrong with that strategy whatsoever.
How does that get you to a Pepsi, to a Lockheed Martin, which seem like the more traditional names we might hear from? Again, that's why I highlight Tesla, because I think it's a much more provocative one. Pepsi had earnings this morning, stocks up 1%. Lockheed, obviously, defense has been doing pretty well lately. Why those two?
There's a different scheme in every stock. They've got different signatures, if you will. Pepsi and Lockheed, to me, are all about stability and ongoing demand. People like their soft drinks. They like their snacks. Pepsi is a solid company with great management, solid consumer demand, capable of handling inflation. So that's why I like that particular name. Lockheed Martin is a similar vein of thought, but slightly different. The world is a very complicated place right now. U.S. defense stores, munitions are down considerably. And, you know, you can argue about the politics of that. But again, I like to stick with the real numbers. And what I know is that we're going to have to replenish all of that. And that's great for a company like Lockheed Martin.
All right, Keith, stay with me, if you will. I want to bring in sort of a counterpart here. We're talking about jobs data versus yield curve. You're taking the jobs data, but Rick Santelli covers bonds for a living. He's got the results of the 30-year right now as well. Rick, how'd it go over?
It went exactly the opposite of yesterday's 10-year. I give this auction a dog minus, a D minus. Did not go well. Let's go through the internals. 21 billion, 30-year bonds. The when issued market was trading 3.654 right before 1 o'clock Eastern. The yield, though, at this Dutch auction was 3.686. It tailed over 3 basis points. Higher yield, lower price. You don't want to sell into lower price structure. pretty much every metric was weaker than 10 auction average. One that really stuck out, other than direct bidders, slightly higher, but one that stuck out, we always like to talk about the buffet table when you have an auction. That's the dealers. They get to take whatever the leftovers are. In this case, the leftovers were just shy of 16%. 10 auction average is 12%. That was the highest take by dealers since April of last year. In the end, this auction did not go well, and I think a lot of that has to do with the notion that many traders are starting to rethink how much time we're going to be spending with rates firming up a bit, and especially with that inverted yield curve, it does start to get a bit confusing.
Rick, what do you say to the Keith Fitz-Geralds of the world and Mike Ferroli, who has research today saying this time is different, the yield curve is not necessarily signaling recession. He says it appears it's driven by the expected decline in inflation. Can we throw this out and no longer matters as a leading indicator?
Well, embedded in your question is the answer, okay? Inflation's going to drop. I agree with that. That is one of the driving forces. I also think that the notion of how this curve is inverted speaks volumes about the long-range forecasts of the Treasury market looking for major weakness. And I will just suffice it to say that you could look at the jobs data, and indeed it was strong, but I would prefer to consider trying to relate all the COVID experiences we have. And in my opinion, whether it was people retiring, coming back in the workforce, government programs that kept people out of the workforce, or notions of, childcare, a variety of issues. But in my opinion, I still think we're going to see a recession. I think the yield curves are right. And I'm not a huge believer in yield curves, but in this instance, I think it's right. And I think that the relationship between what's left of the strong labor market and what the Federal Reserve thinks the labor market does to prices is incorrectly correlated.
All right, we got to go, Keith. Quick last word.
Rick's a genius, love his work, but I am respectfully going to take the other side of that coin and stick with the jobs.
All right, we're going to have a brawl, a good old-fashioned bull-bear debate on this another time. Gentlemen, thank you both, Keith Fitz-Gerald and Rick Santelli. We really appreciate it.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.